Hi there, this is Bruce at Fleet Capital Management. It's Friday afternoon, the 28th day of June, 2024. The week is over, the month is over, the quarter is over, and the first half of the year is over. We're going to take a look at that. This one might be just a little bit longer because I want to show you some things that I've added on seasonality and also on the website, and just a number of quick updates. So I will go through as quickly as I can. We always start by saying the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. I'm always available, Bruce at Fleet Capital Management. Homepage on our website has two buttons. The bottom one will take you to the most recent videos. Top one will put you on my calendar to schedule a call. So in our stock selection process, whenever we pick a stock for one of your accounts, we go through a number of different phases. We always look at the market trend health. That's our matrix, which I'm going to show you, and I've updated that as well. And we also look at the market seasonality of the whole market. Then we look a little bit deeper at sector seasonality, which I will show you in just a moment. Which sector of the market may be doing better than others at different times of the year. And then once we have kind of honed in on that and we know we want to look for some stocks, we do a significant fundamental analysis screening on all stocks available in the United States. I'm actually going to cover this a little bit more, I think, in next week's video. And then once we have a list of stocks that have passed all of our fundamentals, then we do seasonality per security. Just to kind of see if one of those is more in favor for a particular time of year that we're purchasing a stock. And then we always do, and this is really the bottom line, we do a lot of technical analysis to make sure that the stock is worth buying at that particular time. So I'm going to show you a couple of things. So here's seasonality for the markets, and this is updated. And there's a number of different markets, and I put arrows next to the two where we primarily participate, the S&P 500 and the NASDAQ. And what this is showing you is that the strongest period and this is going back 20 years, for the S&P 500 starts at the very end of October, and it goes through and then wraps around for the year and goes through May 5th. That's just the strongest period. It doesn't mean that the market can't go up very strong at different times. It just, this means on average, this tends to be the strongest period. In the NASDAQ, it starts just a little bit earlier. It starts October 9th. Goes through February 15th, and then it has another period, April 15th through July 17th. So again, this isn't the gospel. This doesn't mean we don't invest in stocks when it's not green or in favor, but it just kind of gives us an idea of when the strongest areas of the trends are. And speaking of the market, this was interesting. The S&P index has chalked up an average return of 1.29% between June 27th and July 17th. And positive results have been revealed in 68% of the periods. So 68% of the time during those dates, June 27 and July 17th, the market has been positive. And that's over the last 50 years. So also it says that during years when the market has realized a gain of over 10% year to date, that would be this year, heading into this seasonally strong period, as is the case this year, the results are slightly better with an average rate of return of 1.51 over the approximate 3-week span, with only 3 times in the past 16 instances where it declined. So again, does this mean that from those dates, June 27 through July 17th, the S&P is up? No, but it means over the last 50 years, 68% of the time it's been up, and we're in that right now. Then we go down to seasonality for sectors. These are the major sectors in the market. There are 10 sectors. And what I do when I'm looking to buy stocks, if I have a list of 10 stocks, then I may look to see what sector generally is in vogue, like healthcare right now is, consumer staples is, utilities, not yet, but will be. But we're going to put a pin in this healthcare because we're going to come back to that in a second. But this tends to be a period of time where healthcare related stocks do well. So if I have two different stocks, one is a healthcare stock and one is in industrials, I might lean towards the healthcare because that's a time where that sector seems to do well. And it might, again, we're just trying to stack the odds in our favor. Um, Speaking of healthcare, I recently purchased this stock for a number of portfolios. The symbol is HALO. And you may wonder why. Well, it passed all of our fundamental analysis, it passed all of our technical analysis, it passed all of that. But if you look down here at July, July tends to be, for the most of July, a pretty strong period for this particular stock. And for, let me just clear this up. Hey, 1 second. There we go. For that stock. So that was just one more reason that it looked like a good time to buy this stock. And if you look over here, this is also for this particular stock. In July, and this is 19 years, it has gained 63% of the time. It's an averaged 3.8% during that month, which is outstanding. And then what I like to look at is down here. This is the max return over those 19 years for July, and this is the minimum return. And it shows what year those things took place. And what I'm looking for here is a positive skew, meaning that when it was up bigger than when it was down. If you look in August, you can see when it was up less than the max negative return. So that's not something that I really look for. In February, its max return was 60% and its min return was 23. There's a really big skew. This one looks 50-50. So that's how I use sector or stock seasonality. And again, all we're trying to do is stack as many different pieces of data in our favor. Does it mean that it's going to work every time? No. But when you stack as many things in your favor as possible, you tend to do pretty well. And I'm going to show you our stock performance actually right now. Here's our next slide. So what I do is every single time, this is only stocks, every time I purchase a stock, I put it into this tracking system and they are equally weighted. What I do is pretend that I'm putting $5,000 into each and every stock that I buy. And then I track all of the transactions, the buys, the sells, and all that to see how is our stock performance doing? Because if it's not doing well, then I need to change the system. But from January 1st through June 28th through today, this is completely updated. Here's the S&P 500 in red, and the NASDAQ is in blue. And here is just our stocks. It's not a portfolio. It's not with cash. It's just our stock performance, how it is done. And it did have a bit of a drawdown. We had a couple of, April wasn't really kind to us. And then we ran back up. So I would suggest to you that, and this is just showing, and I don't want to focus on percentages, but this is showing that in that first half of the year, just our stocks were up 45%. The NASDAQ was up about 17%. The S&P was up just shy of 15%. So it looks like our stock picking methodologies are working, and I'm always looking this because if there's anything I can do to tweak the system to make it a little bit better, I'm always trying to do that. The most important thing is the direction of the market. Everything else follows from there. So let's go over to our matrix, and I made a couple of changes on our matrix. The first change that I made is the IBD section that was over here. I've taken that out. That was too slow. And when I look at adding or subtracting anything from a piece of technology that I'm using, my question is it helping us make more money, or is it helping us protect our money more? And I didn't find that the IBD score was doing either, so I just took it off. The other change that I've made is, now remember, this first section is using daily and the second section is weekly. I have changed from go, no go, coloring. It wasn't really helping. to what's called the ADX DI plus minus. And I'll show this to you on a chart. It's much faster. So it will change more. And that's exactly what I want. I want to find early warning signs if things are going down and early warning signs that things may be starting to turn back up. So I'll show you how this is calculated. I'll show you where to find that. But again, this is daily and this is weekly. And right now we're in an up situation on both the daily and weekly timeframes, which is very important. The weekly is really, first of all, group 2 focuses significantly on weekly. Group 1 can also do daily to try to get in a little bit faster because they're a little bit more aggressive. But this is really important because this smooths out the noise that we sometimes see on a daily chart. This is a weekly chart. And then we go to our moving averages. Nothing has changed here. We've got the 8 above the 20, 20 above the 50, 50 above the 200-day moving averages. These are daily moving averages. That's the D. And as long as this configuration holds, that's a pure bullish technical setup. And then this column, nothing has changed. This is our weekly 10-week, 20-week EMAs or moving averages. And this is our primary bear market avoidance indicator. I have other things to help us get out before a bear market starts, but once this happens, we're in a bear market. And then here is our VIX, which is the volatility or fear index. I'm a little bit surprised that it came down this week because this week was a rough week with the triple witching for options, the end of the quarter. There seemed to be more volatility, but the numbers don't lie. So that's the matrix. The only thing that's really changed here is the first indicator for the daily and the weekly. If you look over to the right, I'm going to start leaving these on here as well. Here are the major indexes, and I put arrows so it's easy to spot the S&P 500 and the NASDAQ. That's really our field where we play, and we went over those dates. And then here is the sector analysis for each sector. So I'm going to leave this on here because you can make a screenshot, you can eyeball it, and it just gives us a little bit more information. Okay. Let's go over here. There's our stock tracking. Before I forget, on the firm's website, I have added one page. If you go to the More section and you go down to risk groups and fees, it will now show you, here's group 1. The investment choices are pretty much everything, stocks, ETFs. The risk management is done on a daily basis. And we use stop management on our stocks and our ETFs. The return objective is pretty much maximize returns. Fee structure is 1% count value, but we break that up into monthly. So that's how you read the box. Here's group 2. They have pretty much the same thing as group 1, but they can also use defined outcome ETFs. The risk management is primarily the weekly market analysis, but we also use stop management. Our risk return objective is maximum returns with moderate risk, and our fee structure is the same. Group 3 is they have a different portfolio allocation, and someone who's in group 3, they can have up to 25% in pure market growth ETFs. And then the rest of the portfolio is either in treasuries or defined outcome ETFs. And this is very massageable or customizable to each person that is in group 3. The risk management is market ETF stop management. And then the other things, treasuries don't need it, and defined outcomes already have theirs built in. And this group, this person, investor, would be looking to maximize returns consistent with lower risk. This is definitely a lower risk investor. Their fees are 0.75%, so it's less than group 1 and 2. And of course, it's billed monthly. Billed monthly. And then finally, group 4. This is for clients who are absolutely risk adverse. They want 100% downside protection, and the risk management is done by the investment. And the investments that we're going to use in this are treasuries, which have no downside at maturity, CDs, anything fixed income, and also the Calamos or Innovator, the 100% downside protected market investments that we now have, defined outcome ETFs. So this group wants zero downside risk, and the investments really manage the risk on that. They want to get as much returns as they possibly can with no downside risk, and their fee structure is 0.5% of the account value billed monthly at this rate. So this is now on the website for you, but also if you are talking to someone about our firm and they're curious what our fees are, how we manage things, we have 4 different levels of risk. We have 3 different fee structures, but everything is geared towards matching investments to the investor's level of risk. So I hope you like that. Again, that's just in the more section, and it's under risk groups and fees. I hope that makes sense to you. And lastly, let's go over to the markets. Here's the S&P 500. This is on a daily basis. And what you can see here is, again, this box around here, or this channel, is called the linear regression. I use that just to see if we're overbought or oversold on certain things. When we poke out of the bottom, generally speaking, we have become oversold, and we will come back into, see how it always heads towards the middle? That's called reversion to the mean. Now, if it didn't do that and continued going down, we have a brand new trend. But right now, we're still in an uptrend, as I can see from the moving averages, where the 8-day is above the 20 is above the 50 is above the 200. We're also above the ATR dots that I use. Everything looks good here. We don't have any problems here. Notice that this gray color, this is another piece of analysis that I'm doing. It only has 3 colors. Green means it has momentum. This is a momentum program that I'm using. Green means momentum is to the upside. Red means momentum is to the downside. And gray means it's kind of blended. There really is no direction for momentum, which happens a lot in sideways markets, okay? Because remember, after prices go up, they tend to consolidate or go sideways. But that's just so you know, that's what that is. Down here is the ADXDI. Without going into too much detail, the only things you really need to focus on, there's 4 lines here. This white line is basically showing trend strength. I don't use this line a lot, but this is saying that the strength of the trend was weakening, but you can see prices still went up. So that is not really important to me. The green and the red are the DI lines. The green, when green is above red, it just means that the bulls are winning, and it looks basically like prices are going to continue to go up. It's still green here, still green, still green, still green, and it crossed right there. Let me get my crosshairs out. It crossed right there, which gave us an indication that there might be some weakness. It crossed before the 8-day crossed below the 20. So when I said this might be a little bit more sensitive to where I can see things a little bit earlier, that's what I meant. So that's what this DI is. If the green is above the red, then going back here, it's up. And if the red is above the green, it's down. 2 colors. That's the way it works. And this is a really interesting program. And then the 4th line is that dashed line. That's the 20 line. And basically what that is saying is when this white line is above the 20 line, it could suggest we're going to have a strong, in this case, uptrend. The last thing I use this for is, and again, I don't want to get too confusing on this, but when that white line is below the dashed line, so it's below the 20 level, and it curves up and crosses above the negative DI or the red DI, Generally speaking, we are about to see a pretty strong upside move, and we did. If I look here, it happened in the reverse on the it crossed the green, and we had a pretty strong downside move. Here, it's hard to see, but it pretty much crossed that red line, and again, we had a continuation move. So that's what ADXDI means, and that's all that means. Let's go take a look at the weekly before we leave this. Change some of these indicators. Okay, here's the same S&P 500, but this is on a weekly scale. So each bar is 1 week instead of 1 day. And you can see we're in a pretty strong linear regression uptrend. Not a problem. We are below the top line, which is 2 standard deviations from the red line. Great, no problem. You can see how here we dipped down below and then we came right back up. That's normal. So on a weekly basis, everything looks fine to me. Here's our ADXDI that we were just talking about. Everything looks good to me there on the weekly, and everything looks good to me on the daily. Now, the last thing I want to show you here, let me go back here, is, or that I want to talk about is, again, general seasonality in the markets. We expect to have a fairly strong July. July is, generally speaking, if I put this particular seasonality on here, so I don't have to go back to the other one, you can see June is kind of, doesn't do much in June. July, 76% of July, so the last 20 years, are positive with a 2.25% rate of return to the upside. That's pretty strong. If I go to the Qs, which is the NASDAQ, 86% of the time, July is up, and it generates 3.61%. So July tends to be a very, very strong month. Now, August, over the last 20 years, tends to be August, September, and October tend to be pretty weak months, pretty lousy months. But if you remember a few weeks ago, I did an analysis, and what I did was I looked at seasonality only for presidential election years. That was it. And in that study, August was also a pretty strong month. So we're just entering July. I expect good things in July. I will watch very closely in August. I might tighten our stops, which is fine. It just means if August doesn't work out real well, like normal, well, we'll be stopped out of our stocks. But if we do have that 4-year anomaly in August, we'll continue to ride those prices up. But sometime in August, September, we're going to get stopped out of many of our stocks, and we're going to leave it that way in cash unless we see otherwise. And then we will then go back in at the end of October, which tends to be a very strong period going into the year end. And real quick, I'll go back to the S&P. The S&P real strength starts the very end of October, the 28th of October. The NASDAQ starts a little bit earlier, October 9th. So that's the plan going forward. We're doing pretty well. We're making money. I'm going to try to do some performance reports for individual accounts, and I will email those to you and probably also put them in your Blue Leaf documents, so you have those. But we're doing well, and we are always looking to do better. We're always looking to enhance our returns and minimize our risk, which is a very difficult thing to do, but that's our goal. That's the mandate at this firm. And I hope that is something that you appreciate, that you like, that we're trying to minimize risk. And we don't get it right every single time. I will tell you that when I showed you this portfolio rate of return earlier, I mean, this looks absolutely fantastic. We had plenty of losses in here. We had some losses as well. So that's part of the game. That's part of what happens. We're not going to be right on every single stock, but what we care about is what's the whole doing? What does that look like? And it's showing pretty good numbers. So we'll continue with that. Just remember, again, we have 4 different portfolios. We manage from, pure stock portfolios all the way down to people who want absolutely no risk whatsoever and in between. So if you know anyone that would appreciate this style of work, I'd love to chat with them. Our plan right now is to stop accepting new clients, except for very rarely after December 31st. So this is a great time, and especially for folks who are looking for that absolute downside protection, this is a really great time for those, just because of the way interest rates are. So that's a story. Have a wonderful weekend. I know I went through this quickly. If you have any questions at all whatsoever, shoot me an email, and we will go from there. Have a great weekend. I'll be out sailing and be back here Monday morning taking a look at the markets. All righty. Bye-bye.